What's up guys? Parker here with Barrington Acquisitions. Wanted to make a quick video for you to break down a question I've been getting, which is, do I pay cash for this property or do I finance it? It's a popular question and really it boils down to personal preference. So I'm going to break down an example of what Casey and I have done on the last 3 or 4 properties that we've bought. So it boils down to what you want. Do you want cash flow now or do you want the benefits of principal pay down the road? So what me and Casey have done is we made a goal, and our goal was to have all of our monthly expenses, utilities, mortgage, gym memberships, gas, groceries, all that good stuff. We wanted all of those expenses to be covered by our monthly income from our rental properties. Now, that's a good thing because it takes a lot of stress off your shoulders, and no matter whether you want to wake up and go to work or not, your monthly expenses are being paid for. So that was our goal, okay? So in order to do that, we needed cash flow. And when you're buying a property, you've got 2 divisions of expenses. Let's say your property rents for $1,000 a month, okay? Only count on 60% of that going in your pocket. The other 40% is going to be taxes, insurance, capital expenses such as the microwave breaking, plumbing leaks, all kinds of stuff. The roof needing to be repaired, and then also any vacancy that you might have, and then property management if you're going to bring on a property manager. It's about 40% plus or minus depending on the property and location, stuff like that. Now, let's say the property rents for $1,000 a month. That's only $600 in your pocket. So that's the first group of expenses over here. Now you have your second group, which would be debt service. Now if you paid this property down with cash, everything up front, then you're collecting all $600 a month. But let's say you put $15,000 down and loaned the rest, and you've got a $420 payment. Well, now you're only making $180 a month on this property. Yes, the option B, you have the principal pay down benefit, and what I mean by principal pay down is your tenant over time will be paying off your mortgage. So you only put down $15,000 plus any repairs that you needed, but 20 to 30 years from now, you're gonna have a paid off property that might be worth $150,000 and you only paid 15 plus repairs. So over here, option 2 with financing, you've got less cash in it, you've got the benefit of leverage, and then you also have the benefit of principal pay down by your tenant. Now going back to option 1, when you paid it down in cash, you are accepting the max amount of cash flow possible from your property, but you have more cash in it. So some people say it's better to leverage, some people like more cash flow. I like to do a little bit of both. Like I said before, when Casey and I wanted all of our expenses covered by our monthly rental income, we basically paid as many properties as we could down with cash until that goal was met. And now that goal, now that it has been met, we are starting to leverage. So that's probably what I would recommend for most people is if you have the cash, whether it's from your job or whether you're a real estate investor and you're flipping to create piles of cash to invest, to turn those piles to streams, that's what I would do. I would set the goal. If your goal is monthly expenses being paid for, and let's say you spend $4,000 a month, then pay your properties down cash so you can accept the max amount of cash flow until you meet that goal. And then once you're there, then start leveraging your money. And say for example, the quadruplex that we just went under contract with. The purchase price is $60,000. It's going to need at least $100,000 to get it operating, and each unit will rent for about each unit will rent for about $750 a month, possibly $800 if we're lucky. And so we're going to leverage that one. We're going to put probably $50,000 to $60,000 in it. And then we're gonna, cash out refi. We're gonna pay it all cash, but then we're gonna cash out refi afterwards. So we'll get the principal pay down aspect, and then we will also be able to get some of our money back out of it to go do another deal. So I hope that clears it up. It's a common question, and it really just depends on what you want. So you have to ask yourself, do I want more cash flow now, or am I willing to sacrifice some of the cash flow now for the better cash on cash return and principal pay down the road? Thanks for listening, guys. Hope that helped. If you have any other questions, reach out to me. Check us out on Facebook, Barrington Acquisitions. Y'all have a great day. See ya.